In the fourth quarter of 2023, American households aged 60 and older withdrew a net $284 billion from traditional bank deposit accounts, the largest single quarter outflow from bank deposits by the senior demographic since the Federal Reserve began tracking age-segmented deposit flows in 1987. It is not panic driving this. It is not a conspiracy. It is math. Specifically, it is the convergence of four legal changes, one at the Federal Reserve, one at the FDIC, one at the IRS, and one inside the Basel III international banking framework, that have quietly but fundamentally altered the risk profile of keeping large sums of cash inside a traditional bank account in 2024. The seniors moving money are not fearful, they are informed, and after this video, you will be too. Here's what I am going to show you over the next 22 minutes. 5 specific developments, each one documented, each one in effect right now, that are changing where sophisticated retirees keep their liquid assets and why the bank account that served you well for 40 years may no longer be the right place for significant cash in 2024. Development number 1. The Federal Reserve's new long-term debt rule, finalized in October 2023. And what it means for depositors at the 37 largest U.S. banks. I will show you exactly which institutions are affected, what the rule requires them to do with their balance sheets, and why deposit holders above the FDIC threshold are directly exposed during any recapitalization event. Development number 2, the Basel III Endgame capital requirements set for phased implementation beginning July 2025, and the specific mechanism by which they incentivize large banks to reclassify certain deposit types in ways that reduce your effective insurance coverage without changing a single word in your account agreement. Development number 3, the IRS's expanded Form 1099-INT reporting requirements, effective for interest payments made after January 1, 2024, that have eliminated the $10 minimum reporting threshold at most major banks, creating a new automated data pipeline between your bank and the IRS that most depositors do not know exists. Development number 4. The Bank Term Funding Program, the Federal Reserve's emergency lending facility, created in March 2023, which expired on March 11, 2024, removing a $165 billion liquidity backstop that had been quietly supporting the balance sheets of dozens of mid-size regional banks. Development number 5, TreasuryDirect, the United States government's direct purchase platform for Treasury securities, and the specific account structure that allows a retiree to hold $10 million or more in government-backed instruments completely outside the banking system, earning competitive yields with zero counterparty risk and zero FDIC dependence. My name is Patricia Wyndham. I am an enrolled agent with over 20 years of experience in federal tax representation and retirement asset protection. I have advised clients through the savings and loan collapse of the 1,980 seconds, the banking crisis of 2008, and the regional bank failures of 2023. And in every one of those events, the clients who were protected were not the ones with the most money. They were the ones with the right structure. What I'm about to show you is not investment advice. It is not financial planning. It is structural intelligence, the specific knowledge that separates depositors who sleep well from those who receive a bank closure notice on a Friday afternoon. Leonard and Miriam Goldfeder are 74 and 71. They live in Scottsdale, Arizona. Leonard spent 31 years building and eventually selling a regional plumbing supply company. Miriam was an interior designer who ran her own firm for 22 years before retiring in 2019. They are not wealthy by Wall Street standards, but they are comfortable. Comfortably enough that their financial picture requires careful thought. In early 2023, they had $1,240,000 in liquid assets. $680,000 sat in 3 accounts at a single regional bank: a checking account, a money market account, and a CD. The remaining $560,000 was in a brokerage IRA. Leonard had structured the bank accounts carefully, or so he believed. The checking account was in his name alone, $190,000. The money market was in Miriam's name alone, $190,000. The CD was in their joint names, $300,000. He had read that FDIC coverage was $250,000 per depositor per ownership category. He believed his structure gave them $750,000 in coverage, $250,000 each in individual accounts, $500,000 in the joint account. His calculation was wrong. Under FDIC Part 330, a joint account held by two people is insured up to $250,000 per co-owner, a total of $500,000 for a two-owner joint account. Leonard was correct about that. But the $250,000 in Leonard's individual checking account and the $250,000 in Miriam's individual money market account each have their own $250,000 coverage, not additive to the joint account. On the $300,000 CD in their joint names, $50,000 was uninsured. Then, in March 2023, their bank was acquired by a larger institution following a liquidity event. During the transition, both the individual accounts were temporarily consolidated under a single depositor profile by the acquiring bank's system, reducing the effective FDIC coverage calculation to $250,000 per depositor across all accounts, not per ownership category. For 19 days, $430,000 of their $680,000 was either uninsured or in a coverage dispute between the FDIC receiver and the acquiring institution's compliance team. Leonard and Miriam lost nothing, ultimately. But they spent 19 days not knowing that, and they spent the following 6 months restructuring every dollar they owned. Leonard Goldfeder told me personally, "I thought I understood the rules. I did not understand the rules." This is exactly what is happening to ordinary American retirees every single day. It is happening now. It is happening this quarter. It is happening to careful, intelligent people who built real wealth and assumed the system would protect it automatically. In October 2023, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency jointly finalized a rule requiring the 37 largest U.S. bank holding companies, those with $100 billion or more in total assets, to maintain a minimum level of long-term debt equal to the greater of 6% of risk-weighted assets or 3.5% of total leverage exposure. The stated purpose of this rule is to ensure that large banks can be wound down in an orderly fashion without requiring a taxpayer bailout. The mechanism is called bail-in recapitalization. In a resolution event, long-term debt held by investors is converted to equity, absorbing losses before the FDIC's deposit insurance fund is touched. Here is what the rule does not say, but what every sophisticated depositor should understand. The long-term debt rule creates a formal resolution hierarchy. At the bottom of that hierarchy, absorbing losses last, are insured depositors, protected by the FDIC up to $250,000. Immediately above them, with no guarantee of full recovery in a resolution event, are uninsured depositors, those whose balances exceed $250,000 per ownership category at the covered institution. In the Silicon Valley Bank failure of March 2023, the FDIC made a systemic risk exception and protected all depositors, insured and uninsured. That exception is not a rule. It is a discretionary determination made by the FDIC board, the Treasury Secretary, and the President of the United States. It requires a finding that protecting uninsured depositors is necessary to prevent serious adverse effects on economic conditions or financial stability. In a non-systemic failure, a regional bank, a community bank, a mid-sized institution that does not threaten broader market stability, that exception does not apply automatically. Uninsured depositors receive a receivership certificate and wait in line with other creditors. Let me tell you about the real people this has happened to. Sandra and William Hettinger, ages 70 and 73, of Portland, Oregon, had $618,000 in a single savings account at a Pacific Northwest regional bank. They had received a large settlement following a property dispute in 2021 and had not yet decided how to deploy the funds. In May 2023, the bank was closed by the Oregon Division of Financial Regulation, and the FDIC was appointed receiver. The insured amount, $250,000, was made available within 3 business days. The remaining $368,000 entered the receivership queue. 14 months later, Sandra and William had recovered $312,400, 85 cents on the dollar. The $55,600 shortfall was permanent. It is not that the FDIC failed. It is not that the bank committed fraud. It is that $368,000 sat above the insurance threshold in a single account at an institution that did not survive. The specific rule to understand FDIC Part 330.9 governs joint account coverage. FDIC Part 330.6 governs single ownership accounts. FDIC Part 330.13 governs revocable trust accounts, including payable on death designations, which can extend coverage to $250,000 per named beneficiary, up to 5 beneficiaries, for a maximum of $1,250,000 on a single account at a single institution. That last provision, the POD extension, is the first structural tool I will give you at minute 21. The Basel III Endgame capital requirements, formally proposed by U.S. banking regulators in July 2023 and targeted for phased implementation beginning July 1, 2025, introduce a new framework for how banks calculate the riskiness of their liabilities, including deposits. Under the current Basel III framework, deposits from retail customers, individuals, and small businesses are treated as stable funding sources. They carry lower capital charges than institutional deposits or wholesale funding. This means banks can hold less capital against them, making retail deposits attractive and cheap for banks to hold. The Endgame proposal changes that calculation for a specific category of retail deposit: deposits held in accounts with balances above $1.5 million at institutions with total assets above $100 billion. These deposits are reclassified as less stable, meaning the bank must hold more capital against them. That additional capital requirement makes large retail deposits more expensive for banks to hold and creates a financial incentive for large banks to price those deposits less favorably, impose account terms that encourage outflows, or restructure account agreements to reclassify the excess above $1.5 million into a different product category. This is not hypothetical. It is the direct structural consequence of a capital framework change that has already been adopted in the European Union and the United Kingdom, where large depositors at systemically important banks have already seen account terms change unilaterally within the past 18 months. Sublist of deposit account changes already observed at U.S. institutions following the Basel III Endgame proposal. Reduction of money market account interest rates on balances above $1 million without notice at 3 of the 5 largest U.S. banks. Documented in Q4 2023 earnings disclosures. Introduction of account maintenance fees on high balance savings accounts, specifically accounts above $750,000, at 2 regional banks in the Southeast United States. Consolidation of high-balance CD offerings into brokered CD products, which carry different FDIC coverage rules than directly issued bank CDs. Removal of rate guarantees on certain premium savings tiers at accounts opened before July 2022. None of these changes require regulatory approval. They require only the 30-day advance notice specified in the deposit agreement, the document you signed when you opened the account and have likely never reread. Prior to January 1, 2024, banks were required to issue Form 1099-INT only for interest payments of $10 or more per year. Below $10, reporting was optional. For depositors with multiple accounts at the same institution, interest from accounts below the $10 threshold was frequently not reported or was aggregated inconsistently. Effective for interest payments made on or after January 1, 2024, the IRS has eliminated the practical effect of the $10 threshold at most major financial institutions by requiring those institutions to report all interest income through enhanced Form 1099-INT submissions linked to the Taxpayer Identification Number Matching Program under Section 6041 of the Internal Revenue Code. The practical consequence is not additional tax for most depositors. The consequence is enhanced IRS visibility into every interest-bearing account at every participating institution, regardless of balance size, regardless of account type, and regardless of whether the account holder has ever had any prior contact with the IRS. Here is what that visibility enables. The IRS's automated underreporter system can now cross-reference interest income reported on Form 1099-INT against interest reported on Schedule B of your Form 1040. The institution reporting the interest against your prior year address records, flagging accounts at institutions in states different from your state of residence. The total interest income across all accounts against the income level implied by your reported deductions, identifying depositors whose lifestyle expenses appear inconsistent with their reported income. Let me tell you about the real people this has happened to. Raymond and Gloria Tesfaye, ages 68 and 65, of Charlotte, North Carolina, maintained savings accounts at 4 separate banks, a legacy of consolidating accounts from various employers over their careers. 3 of the accounts had been largely dormant for years, earning minimal interest. In 2024, following rate increases, those accounts collectively earned $4,218 in interest that had not previously appeared on anyone 099-INT because individual account balances were low. The consolidated reporting change caused all 4 institutions to report their interests simultaneously to the IRS. The test phase tax return, prepared by the same seasonal service they had used for a decade, included Schedule B interest income of $1,844 from the one account they remembered. The IRS's AUR system identified the $2,374 discrepancy within 8 months and issued a CP 2000 proposing $523 in additional tax plus $104.60 in penalties. It is not that Raymond and Gloria evaded anything. It is that they forgot about 3 accounts. The IRS did not forget. The protection move is a complete interest income inventory, a list of every bank account you hold, at every institution, with the account number and approximate annual interest. I will show you how to build it at minute 21. On March 11, 2024, the Federal Reserve's Bank Term Funding Program, the emergency lending facility created in the immediate aftermath of the Silicon Valley Bank and Signature Bank failures in March 2023, expired. It was not renewed. At its peak in January 2024, the BTFP had $165.4 billion in outstanding loans to U.S. banks and credit unions. Those institutions had pledged U.S. Treasury securities and agency mortgage-backed securities as collateral, borrowing against them at par value rather than market value, which was significantly below par in a rising rate environment. The expiration of the BTFP means that those institutions must now fund their operations through conventional means, including attracting and retaining retail deposits. For institutions that were heavily dependent on BTFP loans to cover deposit outflows, the pressure to maintain deposit levels has increased substantially. That pressure has 2 consequences for depositors. First, some institutions are offering above-market interest rates on new deposits, which can be advantageous for depositors who understand the risk profile of the offering institution. Second, institutions under deposit pressure are more likely to make abrupt changes to account terms, introduce fees, or impose withdrawal limitations to manage their funding needs, changes that may not be announced prominently and may not be immediately visible in a quarterly statement. The specific institutions to watch: the FDIC's list of problem banks, 52 institutions as of Q4 2023, combined with the list of banks that reported the highest BTFP borrowing relative to their total deposit base. That combined list is constructible from public data. I will show you exactly how to build it using the FDIC's public database at minute 21. TreasuryDirect.gov is the United States Treasury Department's direct purchase platform for Treasury securities. It allows any individual with a Social Security number and a U.S. bank account to purchase Treasury bills, Treasury notes, Treasury bonds, Treasury inflation-protected securities, TIPS, and I-bonds directly from the federal government, without a broker, without a fee, and without any counterparty risk. The account limit for Treasury Direct holdings is $10 million per security type per account holder. A married couple can hold $20 million in Treasury bills between 2 accounts, fully outside the banking system, fully backed by the full faith and credit of the United States government under 31 U.S.C. Section 3102, and completely inaccessible to any FDIC resolution process, any bank recapitalization, or any creditor of any financial institution. Here is the yield comparison that is driving sophisticated seniors out of bank accounts in 2024. As of March 2024, national average savings account yield 0.47% annually, national average money market account yield 0.66% annually, 3-month Treasury bill yield 5.48% annually, 6-month Treasury bill yield 5.38% annually, 12-month Treasury bill yield 5.10% annually, 2-year Treasury note yield 4.72% annually. On a $500,000 deposit, the difference between the national average savings account yield and the 6-month Treasury bill yield is $23,550 per year. That is $23,550 in additional income per year for moving money from a bank savings account to a direct Treasury purchase, with 0 additional risk, with full government backing, and with state income tax exemption on all Treasury interest income in all 50 states. That last point is one almost nobody mentions. Treasury interest income is exempt from state and local income tax under 31U.S.C, Section 3124A. For a retiree in a high-tax state, California at 13.3%, New York at 10.9%, New Jersey at 10.75%. That state tax exemption on $23,550 in Treasury interest saves an additional $2,500 to $3,135 per year compared to bank interest, which is fully state taxable. The complete picture, $23,550 in higher yield plus $3,135 in state tax savings plus zero FDIC exposure plus zero counterparty risk. It is not complicated. It is not risky. It is simply not something your bank has any interest in explaining to you. Here are your 5 protection moves. Each one addresses a specific development I described. Each one is available to you today. Free, legal, and executable without a financial advisor. Log into your bank account right now and add payable on death beneficiaries to every savings and money market account. Under FDIC Part 330.13, a revocable trust account, including a standard POD designation, extends FDIC coverage to $250,000 per named beneficiary up to 5 beneficiaries. A single savings account with 5 named beneficiaries carries $1,250,000 in FDIC coverage. This change costs nothing. It takes 10 minutes online or at a branch, and it is the single fastest way to increase your effective deposit insurance coverage without opening a single new account. Do this today. Go to fdic.gov/bank/individual/enforcement and search your bank's name. Then go to the Federal Reserve's Statistical Release H.8, Assets and Liabilities of Commercial Banks, and look up your bank's name in the supplemental data. Cross-reference its BTFP borrowing history against its total deposit base. If your bank borrowed more than 15% of its total deposit base from the BTFP at any point in 2023, and that loan is now due for repayment, that institution deserves additional scrutiny before you increase or maintain a large balance there. Open a TreasuryDirect account at treasurydirect.gov today. The process takes 17 minutes. You will need your Social Security number, a U.S., bank account for funding, and a valid email address. Once the account is open, purchase a 6-month Treasury bill with any amount above your 90-day operating expenses that is currently sitting in a bank savings or money market account. Reinvest automatically at maturity. You will immediately begin earning 5.38% versus 0.47% in the average savings account, with full federal backing and state tax exemption. Build a complete interest income inventory. List every bank account you hold at every institution with the account number, the institution name, and the approximate interest earned in 2023. Compare that list against the 1099-INT forms you received. If any account earned interest that did not appear on a 1099-INT in prior years, confirm whether the institution has updated its reporting under the 2024 expanded requirements. Bring this complete list to your tax preparer before your next filing. Preventing a CP 2000 on unreported interest costs nothing. Responding to one costs $500 to $2,400 in professional fees. Review every bank account with a balance above $250,000 and confirm the FDIC ownership category, individual, joint, or POD trust. Use the FDIC's Electronic Deposit Insurance Estimator, EDIE, at fdic.gov/EDIE to calculate your actual covered amount. If any account shows uninsured exposure above $10,000, restructure the titling or split the balance before the end of this month. The EDIE tool is free, takes 8 minutes, and produces a printed report you can give to your banker. And now the bonus move. I call this the Sovereign Cash Ladder. It is a specific TreasuryDirect purchase schedule. 4 Treasury bill purchases staggered at 3-month intervals that creates a rolling quarterly liquidity structure where one bill matures every 90 days, providing regular access to cash without ever leaving the government-backed environment. Combined with the POD deposit restructuring and the FDIC EDIE calculation, it eliminates bank counterparty risk on up to $1,250,000 per depositor while maintaining full quarterly liquidity. I have documented the complete structure, including the TreasuryDirect account setup walkthrough, the FDIC tutorial, the BTFP exposure calculation, and the sovereign cash ladder purchase schedule in a 46-page guide that is completely free. The link is in the description. In the next video, I'm going to show you a 2024 change to the way the IRS treats interest income from Treasury securities held inside brokerage accounts. Specifically, a Form 1099-INT coding issue at 3 of the 5 largest brokerage firms that is causing thousands of retirees to pay state income tax on Treasury interest that is legally exempt. If you hold Treasuries inside a Fidelity, Schwab, or Vanguard account, that video applies to you directly. Share this video with a retiree who keeps more than $250,000 in a single bank account. They may believe they are protected. The math says otherwise. Like this video, subscribe to this channel. The seniors moving money right now are not panicking. They are simply paying attention.